Hey everyone, welcome back to Corporate Decoder. Today we're diving into the financial secrets of WTI Fund X Inc. It might sound like alphabet soup, but trust me, there's a story to be told. It's a bit like opening a Christmas present only to find out it's socks, but hey, sometimes socks are exactly what you need to stay warm. So what exactly is WTI Fund X? Think of it as a special kind of investment company, a business development company, or BDC if you want to use the official term, that primarily lends money to venture-backed businesses. These are companies that have already gotten funding from venture capitalists and other investors. WTI Fund X also sometimes invests in public companies or later stage private companies and may make direct equity investments. The goal to make good returns on its investments. The fund is managed by Westech Investment Advisors, which is now part of P10 Inc. But the important part is that the same team is still making the decisions. They aim to achieve superior investment returns for this fund, primarily through secured loans. They are a wholly owned subsidiary of WTI Fund X LLC. As a BDC, there are some rules that it needs to follow, including that 70% of its total assets are in qualifying assets, which means mainly investments in smaller US companies. An eligible portfolio company must be a US company that is not already another investment company, and that either does not have a class of securities listed on a national securities exchange or has an aggregate market value of outstanding voting and non-voting common equity of less than 215 million investments or compta are as securities listed on a national securities exchange, or has an aggregate market value of outstanding voting and non-voting common equity of less than 215 million and 0 million. Now, here's where it gets interesting. As of the end of 2024, almost 20% of its investments don't follow this rule, which means the company has wiggle room and can decide to deploy some of its capital into different places. The fund's manager looks for established companies with at least $1 million in capital, a good cash runway of at least 6 months, sales of at least $25 million projected within 5 years, and previous financing. That's to manage risk to make sure the companies they invest in are relatively healthy. The fund has to give most of its profit back to its shareholder, the company. This is because it is a regulated investment company. The manager has committed to reinvest all the loan repayments received by the end of 2025. To finance the investment, the fund uses a secured loan, which has a borrowing availability of $250 million and was almost fully used, with $239.5 million outstanding as of December 31, 2024. One of the biggest risks for the fund is its reliance on the management team, which makes the investment decisions. If something happens to them, the fund could be in trouble. Competition could also increase given the low barriers to entry in this industry. The manager gets paid a percentage of the committed capital each year, and the amount goes down as time passes. This management fee is a hot topic because it may not be reflective of total assets. This could occur, for example, if the fund does not originate as many loans as anticipated, or if the loans in the fund portfolio are repaid at a rapid rate during such period. Like every other company today, the fund has to worry about cybersecurity as well. If there is a cyber attack on the fund or its portfolio companies, it may result in financial losses, inability to transact business, exposure of personal information, and other unwanted regulatory and monetary penalties. However, it looks like the fund has taken this seriously. The audit committee reviews cybersecurity each quarter and presents to the board of directors. Alright, now for the moment you've all been waiting for, the financials. Here we can get a peek into the performance of the fund. First, a bit of good news, the net increase in net assets, which is basically the profit for the year, increased to $31.5 million from $25.3 million in the previous year. 2023 looks like all the key people in senior management were the same as last year. It's worth noting they say some borrowers may be impacted by rising inflation, which could affect their ability to pay their debts, which translates to the fund's bottom line. Let's quickly glance at one of their key tables, interest expense. Here's the deal. The cost of borrowing actually decreased a little bit for the year, despite an environment of rising interest rates. They say it also doesn't expect changes in short-term interest rates to affect their loan payments, which means stability for the company. But that might not be a great thing if rates do go higher. Finally, before I give my take, note that at the date of the report, the fund had not adopted any insider trading policies. And now let's put on our investor hats and assess what we've uncovered. What I found is a pretty straightforward story of a company trying to make profits by making secured loans. The profits for the year increase, which is a basic and important metrics for the company. The fund had some wiggle room with deploying capital as of the end of the year. The downside is the report relies heavily on a small management team. A hiccup can really turn things upside down. Also, there are rising concerns about cybersecurity, which can be very troubling for companies operating in the financial sector such as this one. Finally, there are some accounting choices on loans could mask true risk. Overall, this business development company seems stable but not very attractive. Proceed with caution. And that's the story that this SEC filing tells. Thanks for watching Corporate Decoder. If you found this breakdown useful, please subscribe, like and comment. What companies or reports should I look at next?